All right. Hey, everyone. Hope you guys are all having a very, very good day. Hey, Villa. Happy to see you guys. In fact, I forgot Loki's treats, but I'll have to give him a treat a little bit later. I'm sorry, bro. I'm sorry. I know. I just remembered that. It's okay. But hey, everybody. So today, obviously, it's all about the Fed. What's going on? We'll have the announcement about 20 minutes or so. And I think you'll most likely see the market be a little bit more volatile, that's for sure. I'm going to pull up the 4-hour chart here in just a second, and oh boy, it's going to be, I don't even want to call this, it's going to be a fun time, right? We're barely holding on to a level of support. We saw Bitcoin come down quite a bit over the last few days, and we've seen altcoins come down quite a bit. However, at this point in time, the entire market kind of seems flat when you look at the stock market. It's Bitcoin that's down about 1 to 2% here. Altcoins down about 3, 4, 5% right now. It's not the best, but still, you know, we'll have to pay attention to this. And hey, Dolphin, happy to see you, my man. Thanks for being a member as always. Hey, Razvan, what's right here from Romania? Oh, damn, you're far, man. I appreciate it. And hey, OPB, happy to see you, man. OBP, excuse me. No, I don't have a treat. I'm so sorry, bro. I'm so sorry. I'm so sorry. I forgot his treats upstairs. And now he's all mad at me. He's like, where's the treats? I know. You'll get a treat in a little bit. I know. I know. He's being, here. You can come up. Yeah. I know. I know. Is this you revolting? Yeah, look around. Look around. There's no treats. I know. I'm so sorry. I'm so sorry. I had a treat saved for him, but I gave it to him last night a little bit early. I'm sorry. So, I'll have to give Loki a treat after this when I take him outside for our daily little walk. And hey, Mo, happy to see you in the Doberman guy. Oh, nice. Hey, billionaires. I don't got a treat. Nah, he's really mad at me for not having a treat. But anyway, let's take a peek here at Bitcoin. There we go. A couple things before I actually go into the technical analysis. I got the press conference ready to go. Whenever it goes live, we'll be fine. This is counting down to about 50 minutes, so that's pretty much how much time we have before I believe Chair Powell does start talking. So it may, he may take a little bit extra time or something like that. Excuse me. On top of that, I don't have it now, but I guess I could go to CNBC right here, the live stream. Sometimes it works, sometimes it doesn't. It's been more glitchy lately, maybe because big news has been cracking down on these types of things. There we go. And so I do have access to CNBC right here. So when the announcement does come out in about 20 minutes, well ahead of that 60 minutes we just talked about, that 50 minutes we just talked about, we should be able to pull it up here and listen to it. At least that's the goal. So I'll have this in the background here pretty soon. I don't think we need to ad blocker detected. Oh my God, hold on. This is for this one. I guess it's worth taking the ad blocker off. But yeah, so this is also going to be going on in the background here pretty soon. So when it actually does come to pass, that we know exactly what the rate cut is, the dot plot, we'll see all of it, and we'll be able to see what's happening with Bitcoin here, and is it like really popping up to the moon, or is it just crashing and burning? So yeah, it'll be fun. And hey, Distort, happy to see my man Mr. Tanker. Happy to see all of you guys here. Hopefully we get a pump later after this FOMC meeting. It all depends on how it's presented to us at this point in time. If you go over here, I was looking at Bitcoin, but there's not really news about Bitcoin. Everybody's just kind of depressed today because, you know, the price is down like 1.5%. But there you go. When it's FOMC day, market, there's a 98% chance Jerome Powell starts today's FOMC press conference with "Good afternoon." Last time he skipped to the Dow, plunged 800 points. But yeah, so there's nothing really here. This is from September. FOMC, like they have posts, like X is still broken in my opinion, bit by bit. But everybody's gonna be watching it soon. Everybody seems to be very excited, I guess you could say. I'm freaking worried. Like, I already have my longs in place. We did that 200x leverage trade for a little bit, and we ended up selling it up here like around 105,000 bucks, like way earlier than, you know, the 108,000 that we ran up to. But yeah, for me, I'm more concerned than I am like excited for this, because once the announcement comes out, we really do have a plan of what should be happening over the next like 3 to 4 months, and that could really make things either very good or very bad. So, you know, it's like getting a failing grade or a passing grade on your final exam, which is worth 80% of your entire grade. It's that type of stuff, right? So, well, we got to see how it works out. The legal system in the United States is a joke. Yeah, it's been that way for a hot minute. Powell, hello, and everything moves 5%. Oh, I wish. Just, yeah, I mean, like here. So we were talking about this other day. So, you know, Bitcoin, the only reason we haven't gone into Bitcoin, despite MACD being strong, RSI being strong, all that stuff being strong, is because of the FOMC coming up today. That just messes with all the technicals. And I'm just going to stand by that, is why I didn't open up a trade over the last few days. Theoretically, you guys would have opened up a trade back over here on Monday. Right? That's not so long ago. We managed to break out on top of that, and it's still just, you know, you're not getting that good feeling from Bitcoin because this FOMC, the fundamentals of what's been pushing Bitcoin higher, besides all of us just buying, it's going to change here. So we may see, like, you know, just a bunch of stuff change here over the next few days. Let me see over here very fast. How's everything else looking? This is a daily chart. Ethereum still holding support. Solana holding a small support over the last few days. Let's see. Doge, hold on, still trying to hold a support. I don't know. With breaking below support. Bonk still holding. Miro's breaking below support. Baby Doge is up a little bit, but after, yeah, like a week of going down. STMX coming down a little bit, not below support, but still not good. Book of Meme coming down quite a bit. Sheep coming down quite a bit, yeah. Floki, yeah. So there's a lot of stuff right now, guys. It just does not look that bullish. XRP looks okay. Bitcoin Cash, Chili's, yeah. So I think altcoins are the majority of all the pain we're seeking right now. It's all altcoins. All right, so let me go back over here very fast, just do a quick little peek. Anything up over the last hour? Pudgy Penguins is up a little bit. This thing is kind of glitched out because it is relatively new. Move is up 2%. AO's network is up 1.5. Bitget token is still rising right now, which is interesting. 428 right now. Holy shit. Yeah, this thing is actually moving quite a bit. I might have to sell my token here fairly soon. I'm surprised Bitget's getting so much more attention right now. Okay, but yeah, generally speaking, not much. A lot more, oh yeah, look at that. A lot more red here over the last 24 hours. Litecoin's down almost 9%. Near is down about 8. Phantom's down about 8.5, 9. Yeah, Dog with Hat's down about 11. Bonk is down about 12. Ooh, man. Oh, what are the most visited for the last hour? This is interesting. Bitcoin, XRP, Pepe Unchained. This is interesting. So you can see what people have really been looking into. Pi token. Yeah, self-reported market cap. No, get the fuck out of here with that shit. Self-reported. Pi is not worth 50 bucks. Yeah, this is a fucking shame right there. ADA, 36, yeah. $1.05, yeah, okay. This is new. They're making some updates, and I like it. Trending over the last hour. Unusual. Oh, yeah, that's up to 30%. All right. I'm going to have to get used to this, so this will be kind of fun to make some quick videos up through the day. You know, the most trending tokens for the day or something like that. Could be good for those of you guys who want to be some day traders. Got a buyer at 34 for Doge. Should I wish for the dip? I mean, most people do wish for dips, to be honest, on days like this because they just want to go swooping and buy a bunch of tokens. It's not a bad thing to want to dip. It's just like you don't want the bull market to end. We have tons of dips during a bull market, right? I think it's always easier to show you guys stocks and stuff like that. You go over here to SPY or the NASDAQ, right? You zoom out on the weekly chart. You know, there's been some pretty good sized dips here over this. This is all, you know, 2024. Really good dips. The NASDAQ fell from high to low like 16%. Big dip right there. Multi-week dip back to 2013. Dip right there, you know. As long as it's in a bull market, usually you're fine. And we finally got that first really big move after this breakout. It was like, okay, things are gonna, you know, fix themselves now. Things are kind of bottoming out. Now you can start to buy more aggressively. So every time there's a dip, you can definitely take that chance. Or you can just dollar cost average whenever. But if you have a limit order, yeah, it's better just to buy the dip. There you go. Because right now, I mean, Bitcoin's just hovering right now, has no idea what it needs to be doing and the Fed announcement hasn't come out just yet. And hey, Alan, I'm happy to see you. Am I going to take any trades live potentially? Dump then pump maybe? No, I don't like to trade stuff like this because I have a worse average than my swing trades. I prefer just to trade when I know I have like a really high chance of success. So usually that's going to be when we have these types of major breakouts with all the momentum facing it and no big news. That's usually when everything starts to glide. You can use a lot of leverage. You can make a lot of money with it. We did a trade. When's the last time we did a trade? Like 3 days ago, 2 days ago. We made about 600% off of it with a 200x leverage, so really high risk. But it was fun to trade for sure. But I don't know if something like looks like a clean setup. Maybe doesn't look like there's really any clean setups right now though. I mean, you could see this last attempt at a breakout right there. What? That didn't really work out. You could even try to pull this back a little bit. I mean, even that didn't work out. So the technicals aren't going to be as clean as we want them to be at this point in time, just because everybody's waiting for the Fed. Let me go over here to CNBC. Starbucks. We're talking about Starbucks. Nobody cares about Starbucks. Although I may be going up to Starbucks Seattle's. Yeah, I'm going to Seattle on Thursday for a holiday party and a business meeting. I wonder. Maybe I'll stop and get some Starbucks coffee. I don't like Starbucks. No, you know, I'm just gonna go to a nice restaurant, get myself an espresso, and I'll be happy. I've been really digging the tiny espressos with those little orange peel in it. Absolutely fantastic. I went out to dinner last night to treat myself. Well, more like an appetizer and a couple drinks. But I got myself some caviar. It's freaking delicious. Except for I have never had caviar from this place, so when I see caviar, I'm always imagining what it's like in the movies where they have like all the shells and you're like, you know, you use a little fork and you like pull it out of the shell and stuff like that. Well, that's not exactly what I got, but it was still really good. Let me see if I can actually find it here. Short. Check this out. Yeah, I got 5 snails. It was like $30. But the cheesy bread is really freaking good. Really freaking good. But yeah, freaking inflation at the snail market. I did not know snails were so expensive. It was absolutely delicious. It was hot. I used lime. It was really good flavor and everything like that. But man, when I say, you know, $30 for 5 snails, I can pick those fucking snails up off the ground in my backyard. And hey, Lox, happy to see you. We're about to pump hard on sushi. Don't miss the pump. What do you call crucial levels on the whiff? Yesterday, so many opening high leverage longs and XRP and what? Let's see. Major crash coming. Panga was pushing 90%. Damn. Okay. Hey, Cameron. For me, I think it's worth holding maybe $100 to $200 worth of it, but it's going to take a long time, which means you have to hold a long time if you think anything could ever like really threaten Bitcoin in that sense, right? Bitcoin is old, it's very slow, it's inefficient, but it's what everybody has clung on to here, mostly because there's only going to be a set amount of these tokens, no inflation, stuff like that, and people seem to love it, especially since it's been around for so long. I think eventually there will be things that have a much larger market cap than Bitcoin for sure, but that's like you got to hold these suckers for years, and it'll be easier to get those tokens once we have regulation. Ethereum may overtake Bitcoin one day. Tron may overtake Bitcoin one day. You know, it's just going to take some time. A lot of time, actually. If we get some good news, Pepe looks really to pump short-term 4-hour. I mean, how long do we have, guys? We have about 9 minutes left. Let me see. We got CNBC right here. I got the music going at the same time. So I'll pause this pretty soon when we I'd say a few seconds beforehand, because let me hop over here very fast. If I make this full screen, that's enough for you guys to see right there. Yeah, we're good right there. I can't play it just yet, but we'll see. Tech check, let me see. Tech volatility. But it's because tech is so propped up with so much freaking money. That's why it can easily be pulled out. Let's see. Crow is down 15% today. Had a nice little spike yesterday, looks like, so it's just coming down after that. Theta's down quite a bit. Geez, yeah. Pendle's up today, which is interesting. That's not bad. Injective's up a little bit after a really rough few days. Moodang, how's that one looking? Still coming down. Tron's down a little bit too, yeah. It was an attempt for a lot of tokens to have a big rally yesterday, just didn't really hold up. Almost like a little bit of a bear trap here. Let's see. I think the 1 minute chart's going to be best when looking at Bitcoin assets. Thanks for having the live stream during this. Always hard for me to find the Fed updates live. Oh, no worries. I've been trying to do more of these morning streams anyway, so I figured this would be a good thing. I just stayed out too late. I didn't even stay out too late. I just stayed up too late last night. I went to go get myself some escargot because it's always tasty. I had a few drinks at the bar, talked to some people, and then I went to go smoke a cigar with a buddy. Then I came back over here and I was just like, you know what? Let's play some video games or something. So I stayed up too late playing video games. Then I woke up like at 9 o'clock. Didn't get out of bed till like 10 o'clock. Washed my face and all that good stuff. And I was like, okay, now it's time for the work day. I mean, it still looks like Bitcoin is trying to hold that Fibonacci level. This was a pain in the ass, if you guys recall, a few weeks ago or a couple weeks ago. But now we are using it as a level of support. That was your breakout for your reversal. For those of you guys like to catch a falling knife, typically you look at that right there and be like, hey, you can buy right here, right there. All right, don't wait for that pop. Pump a dump, nobody knows until the news comes out. There's no way to know until the news comes out. If you're taking a trade right now, it's more of a gamble. The press conference is in 35 minutes here. Nobody's talking about the FOMC on X right now. Yeah, really, it's bad. Let's see. This is my post from a while ago. Let's see. Less than 10 minutes. Ash Crypto's the only one talking about it really right now. I mean, my old posts are stuck in here too, so really, FOMC, there's just not much news about it, which is crazy. Once the news is announced, everybody will be retweeting and tweeting and stuff like that. But until that, it's just ick, you know? Got 5 minutes left. Oh, I guess this actually is important for those of you guys that were paying attention to it. There was a statement from over here. Haley is still MIA. But over here did make an announcement. I'll try to read this really fast. All right. The truth. When they label as the truth, sometimes it's not the truth. We only built airdrop tech for Web2 fans for free. We saw Hawk as the perfect use case for our startup idea to bring airdrops to Web2. Haley Welch, a literal meme, launching a meme coin felt like synchronicity. Our goal was simple: bring Web2 fans into Web3 seamlessly. A way to bring Web2 into crypto through culture, not just speculation. First of its kind, that's it, for free. We believe that in that vision so much we pushed harder and harder. Perhaps through rose-tinted glasses and naivety about others' intentions, even as the project began to unravel. The facts about who did what. Official team Doc Hollywood controlled all token decisions, fees, treasury. Haley's team seeking Web3 potential without having an experienced Web3 partner to understand its various intricacies. And then over here's unofficial uncontracted role: build free airdrop tech for real Web2 fans to onboard them to Web3. Damn, I can't read fucking today. Our tech was non-core feature to the launch, a new mechanism designed to reward real fans. We didn't even have a contract with the official team, which is why we took zero fees, zero profit. So why did we end up doing more? Because Doc's team vanished when things got hard. Oh, okay, man. So basically, it's not their fault. It's all Doc Hollywood's fault. Doc Hollywood is the big scammer here, yada, yada, yada. I don't know who's the scammer, who's the not, but I think Doc Hollywood's been a scammer for a minute, so they should have known, you know? They should have known that he was no good. So we may end up hearing more news in the future, but yeah, I would never work with that brand over here. If they were willing to work with a scammer and they don't know how to vet, that's a big, big red flag right there. If you love strong emotion, to open a position now with no leverage, with no stop loss. I mean, theoretically, you could do that. Because we are having a cut, you could see a big spike up before we start to look at the dot plot. So the initial move could be very bullish and then spike back down, or reverse, it could spike back down really fast and then come back up. But yeah, it's going to be fun. In fact, what I want to do very fast is I'm actually just going to move this over here to the side. I'm going to do this. I'm going to move this over here. I'm going to pause the music. I'm going to move the audio up a little bit. Let's go to 90%. Yeah, all right. Just so when I'm talking, I can talk over it a little bit. I need to do a couple things, though. Let's turn my audio down so I cannot hear my own voice. Oh, that's beautiful. That's beautiful. And then... let's see. Oh, I think the website's glitching out on me as soon as it's supposed to come out. Let's see. Yeah, I think the website broke as soon as I actually needed it. Let's see over here. Yeah, they're definitely overwhelmed at this point because my computer's running really slow with this stuff right now. Let's see. Oh, well, at least we can watch Bitcoin in real time as I try to figure out how to do this. I might have to just window. That other cluster is really messing up here. Oh, it's the website that's slowing down my computer, not anything else. Okay. Let's see, well, there's the move right there because it just came out. Let's see. Oh, that is not a friendly move right there for us at all. Let's see if this is the right one for us.
28. We have one dissent. New.
No, this isn't the right one. It always gets the wrong thing. So let me try. Yeah, no video for today. I'm not going to keep on trying to do that. All I can see is Bitcoin did not like the reaction at all, which is what my fear was. But let's see. Usually it kind of figures itself out before he comes out to talk, and Jerome Powell's not coming out to talk for another 30 minutes here. So I'm going to keep on trying to figure out why isn't CNBC working. Or I don't have my wallet on me. I can't buy CNBC Pro right now. Let's see. The announcement was another 25 basis point cut. You can see it right on Twitter. Latest. Breaking Federal Reserve cuts interest rates by 25 basis points, just like that. Now everybody wants to tweet it. See, now everybody wants to tweet it. Yeah, it's just a typical 24 basis point cut. What we're looking for, though, is the dot plot. And I don't know why this fucked up right when I needed it the most. Let's see. See. Let's see. What are we at? I mean, so far on the daily chart, it doesn't actually look too dramatic. We're still holding support. I think that's a good sign for us in the short term here. 1 minute chart, 5 minute chart, maybe a little bit different, but you know, I think it still looks okay for us. Let me. See. No, I can't even get Fox Business on the website. I wonder what's causing it to glitch out. I wonder if everybody had to go bootleg it at the same time. Let's try this. This might be something close that we can do. Let me pull this up. Maybe if it actually loads up here. We have $104,246 right now, still coming down. Think we're going to break 102,000? That could definitely happen later on today, but give Jerome Powell time for his press conference first. I don't think we'd break down below that in the next hour or so. Let's see, refresh this. Yeah, all the sites. This is one of the times where I wish I actually paid for cable, but I don't watch cable or anything like that. Like, because right now we're just barely holding on to this fib level, and they're trying to push us down. They might, but that's when I think things actually turn ugly for us. Let's see. Bloomberg. Maybe this one. Yeah, we can deal with this
scenario
one.
analysis.
Right, hold on a second here,
How
guys.
do you take into stride the prospect of both tariffs as well as potential changes to immigration?
To me, the character of the dissent's interesting. I don't have time to study it, but the uniqueness of, she's quantitative economics out of Stanford. She certainly knows her way around the block, but that's something. Your first meeting and you dissent? I mean, what would Alan Greenspan say to that? That's like Lawrence Meyer 101. But the answer here is the markets are moving. I'm looking at yen out to a 154 level. Damien would look at it 8 different ways. But the answer is this is not a snooze fest, and there's a lot going on here in a more than expected hawkish cut.
This is what they call a hawkish cut. I could not agree more. And that's just what's
there you go,
happening at the
hawkish
front
cut,
end
and
of
we're
the curve.
breaking
Even
down
as they
at the same
reduce
time.
interest rates
That's
by
no
25 basis points, the 2 years higher by 7 basis points. We're back through 430. Bob Michael at JP Morgan's had some time to go over the statement, to go over the projections and the market reaction. What do you make of this one?
Well, I think they have an incredible sense of self-awareness, that the economy looks great. The fourth quarter is going to come in around 4%. You've got unemployment at 4.2%. They'll take the side of it that says that's a pretty good level to be at. Inflation's a little bit above their target.
Oh, damn, yeah, we're definitely heading down
What's the
now.
rush to keep cutting rates? Let's just back up a little bit. I think also they do have to listen to what's being talked about at Mar-a-Lago. And there is a lot being talked about. Not any of it is going to be disinflationary or a headwind to growth. And they have to begin to model that in. I actually think they did the right thing. I'm pleasantly surprised. They went to 2 cuts next year.
We're going to listen to a boring Bloomberg, but Bloomberg it is. I don't even know what
Does
exactly this is.
The Trump administration model in his behavior, his statements on strong dollar
pull this up right here. There we go.
I don't know, 8 years ago, whatever the math is.
My portfolio is over 70% Bitcoin. I'm just hearing a good taste of Ripple, LR, and
XRP. Strong
XRP.
dollar for President Trump. He's going to demand a weak dollar. We got to have exports up, or is there new behavior?
I think that's something we're just going to have to wait and see. I think
was he hawkish? It's a hawkish cut.
It's a hawkish cut,
of the dollar, which is very interesting. And hey, I'm happy to see, man. So yeah, definitely not good news for the overall market here. It means we're probably not going to have another cut for a minute. We may, in fact, actually start to pause here, and a pause would be a disaster for the markets.
As expected, then you're going to see
it'd just be bad. I mean, you're going to see rates freak out. Like here, this is Bitcoin, as you guys know, 1 minute chart.
Start to appreciate a bit.
Gold.
Do you think that it was a mistake in essentially essentially, this is the
Japanese
Fed walking
yen,
back what
boom.
Fed Chair Powell said about we will
Dow
not
Jones,
welcome any
boom.
further weakening in the labor market.
NASDAQ, actually NASDAQ's, oh no, this is a 15-minute delay because I don't pay for it when we call. SPY, boom. NASDAQ must be doing the same exact thing.
When they look at everything,
Russell 2000,
it's the perfect
boom.
soft landing.
Dollar
They're
index
looking for a resting
skyrocketing.
spot. They don't
U.S.
think
oil
it's 3 or 4
down.
rate cuts
I would say
away.
flat
they
overall.
Think it's somewhere around 2 more rate cuts away.
Do you think that
Ethereum
it's good
down.
that there's more dissent now?
Down.
At
Oh
a
my
time when
God.
there is so much dissent and disagreement just about understanding where we are currently?
We'll bottom out here soon enough, I think. But yeah, the market definitely does not like this news. We'll have to keep a closer on it.
Things are about as perfect as you can get them. I try to point out housing, and she smacks it away. And I think that's what you're getting at the Fed, which is, you know what? Inflation's a little higher than we want. Growth is a little bit firmer than we thought. The labor market looks pretty healthy. And by the way, has anyone
labor
talked
market
about
is showing cracks.
holiday
I just
sales?
have another friend that just got laid off the other day.
Pretty good.
It's happening more and more.
What are we doing cutting rates further?
I look at this, John, and of all the things moving across the Bloomberg launchpad, Canadian dollar is extraordinary. We're not near a 144, but it's a jump condition, unlike others which are just pushing up as well.
They've got their own Trudeau-shaped problems, Tom, and Europe's got their own problems too. Euro dollar right now breaking down to 104.20, just about holding on now to a 104 handle. There's one question I've got for you, Bob. It's a forecast we haven't talked about.
The markets are definitely freaking out about this. All right, let me go back over here. I bet it's trending now. We might actually get some good news.
To 3. Is there not a bigger realization going on at the committee that needs to come up a whole lot more? Why is this taking so long to draw that conclusion?
Yeah,
Congress,
I think the realization is setting in, and I think having a dissenter on board is going to help drive that conversation. But if you step back and think where 3% is relative to a few years ago,
nobody's talking about it yet.
Pretty high. We've had negative real Fed funds rates for a long period of time. The very first dot back in 2012 was 4.25%. Now we're right about that 4.25%. Why not just sit there and say, we can get to around 2% inflation. About 1% of a real Fed funds rate is about the right level of pressure. I still think it's going higher.
The chairman talked about a recalibration. We've had 3 meetings, 100 basis points of cuts across 3 meetings. Was that the recalibration? Have we had it now?
I think that's some of it. I think
you think that's only part of it?
Yeah, I think that's only part of it.
Bitcoin's still going down right now, guys.
It just takes a weak labor print over the next month or so. It takes a surprise to the downside in core PCE. One of those things to remind the Fed that this level of rates with a 4 handle
your Tesla 2X Bear ETF
that's come from zero
making some good money
rates is still
Tesla did pop up way too much over the past
and there's
month,
more work to do.
If you are just joining us, welcome to the program.
Ethereum's institutional plan will get the massive inflow. Yeah, eventually, just give it time. Just give it time.
That's not what the headlines are. The headlines are in the summary of economic projections released alongside the statement from the Federal Reserve, where they increased their forecast for GDP for 25. They took down their unemployment rate forecast. They pushed up their forecast for PCE, and they did this
we're still getting pushed down. We may get back to $103,000 pretty soon.
390.
A little bit of a heads up, guys. We also do have the Fed speaking in about 19 minutes. So once he speaks, maybe things will level out just a little bit more.
To just 2. Off the back of that, in the bond market, yields are higher, the dollar's stronger, and equities are rolling over on the S&P 500. We are down by 0.6%. To weigh in on this, Diane Swunk of KPMG joins us now. Diane, you've had some time to pore over all of this. Let's start with those projections. Was that in line with what you were looking for?
Why is my one so great out?
And I'm
you know what
glad
I mean? It's
to
looks
see
so
it.
gray.
I thought that the Fed was going to, if they were going to do a quarter point, which was already priced into the market, that they had to scale back dramatically, at least by half.
I think what I'm going to do is
for rate
pull
cuts
this over
next year,
here,
which is what they did.
Exit that. Pull this over here very fast. Do this. Move the window capture over to this new tab. See, there you go. There we go. Okay, let me put this audio on.
I think it's not surprising at all that there were 3 participants at the meeting that also agreed that they don't want so many rate cuts. Next year, the economy, they can do it without front-running any policies. Right now, the economy has come in much stronger than they expected. There's been upward
every time they say the
revisions to
economy
both
is really strong, it kind of irks me the wrong way, if
inflation's
that
come
makes
in
sense.
hotter, and the consumer is atlas to the U.S. economy and the world at this point in time, and that's important. I think it's also going to be really important to see in the discussion and in the minutes to this how much they talked about that consumer sentiment number that showed people buying ahead of price hikes and that hoarding activity, which suggests that perhaps inflation expectations are not as well anchored as they thought and have become a bit more
good time to short. I'd wait for Jerome Powell because he could always change his mind about stuff. And also, Bitcoin's long-term momentum is still pretty strong in the upward direction. So you could easily see shakeouts and bull traps and bear traps here. So it's just going to be a little bit more of a volatile experience. But generally speaking, for the long term, yeah, you're going to see a lot of long-term shorts, low leverage type of plays. Especially if we are going to have like a pause coming up pretty soon. Once that's kind of confirmed through the press conference, I think you're going to see a lot of people just start to short.
Both Americas. I think people don't realize how much time he spends talking to people who are trying to upskill themselves
5-minute chart
and get out
like
of
that,
being
more
paid
dramatic,
by the government
way more dramatic.
and get training, especially single women.
It's not a good
children.
time at this
I know
point.
how
Again,
much he spends
Bitcoin's
time.
not the only thing falling. I know altcoins as a whole are falling. U.S. oil sideways right now. Dollar index spiking. Russell 2000 dead. SPY
I think what's
dead.
important, I mean,
Dow
I think
Jones
about this
dying.
in my own
Gold
situation.
dying.
My son, when I
right
asked
now.
him what he wanted for Christmas, he asked me to donate to the homeless.
It is what it is at this point.
And
if we're lucky, we'll get some help.
A real problem. And I think that is one of the issues that we're struggling with. And interest rates alone coming down are not going to change the supply of housing. That once was the single
it doesn't
level.
always drop
We know
down.
that
It usually will be
has been
volatile and
bid
it'll
up by
level
a
out
whole host of
afterwards. But
factors,
there usually is a level
including
out,
scarcity
and
of
that
labor
leveling out usually
these recent
ends when
disasters
Jerome
that
Powell
we've
starts to
seen,
talk.
which are pushing up the costs of actually construction.
Because of this fragility, and
hey,
Bob,
Jackie, I agree. The lines at
thoughts.
Chick-fil-A down
Some
to 10
people are
cars.
saying
Yes, that's
that
different. Yes,
essentially
that's
this is a hawkish tone.
I don't think the
but
economy
this
is
still
as strong as they're
Fed
saying.
with a pretty
And I
low
think he's
bar
going to
to
fuck
cut
it up
again.
again.
That is the
And if
comment
we go into
from Neil
recession,
Dutta as he looks underneath
the media is
hood
going to
of
blame
some of the
Trump
employment
because
markets
that's what
that,
they do.
Diane was
But
talking
in
about.
reality,
Do you
be
agree?
Jerome Powell not understanding what the economy looked like at the time.
Was
and Trump will
low.
rail against him. Republicans will rail against him. Even Elizabeth Warren will rail against Jerome Powell. But
how many cuts they have
it does
to
have
do.
me concerned that he really does have a
by the
pulse of
time
what's
they
going on in the
meet again
economy
at the
right
end
now.
of
Because again,
January,
all the
they're going
information
to
is
hear a
lagging.
lot
He's
more
not
from
looking
the
at like real time
administration.
stuff.
And it's going to be the administration.
He has like some real time
not
data,
the
but I don't think
incoming administration.
I don't think he
and
understands.
They're clearly going to have to model that and weigh that. So I don't think there's a pretty low bar here. I think it's gotten higher.
I'm really pleased you brought up Neil Dutta's note. If you go to the bottom of this note, Neil from Renmac, of course, there's an interesting line here in the incoming administration. There is plenty of speculation of what the Trump administration will do, but they have to actually walk through the door. The Fed ought to focus on the here and now. The risk is now that the economy slows and the Fed is passively tightening by doing nothing. And here's the kicker, I think the punchline. Curious that the Fed was about to cut 100 basis points and then all of a sudden stops as Trump walks through the door. Diane, how much of these moves, the change to the forecast that we're seeing, are about the incoming data since September, and how much of it is about expected changes to policy that will shape that data in the years to come?
Well, we do know that with the continuing resolution that they're talking about a fairly large increase in bailout funds for the affected states from the 2 hurricanes. That will boost growth at the beginning of the year, and it is inflationary at the same time. So that is sort of already baked into the cake. Are they doing scenarios? Of course they are, but they can couch, certainly, I think you're going to see Powell couch very much and be very cautious to say they're not front-running any policy. They did cut at this meeting. If they were front-running policy, they wouldn't have cut at this meeting. And I think that's what Powell wanted to say, even with a dissent, with this hawkish tone. This is sort of the perfect way for him to say, we're doing our job, we're looking at the data, it's coming in stronger, the economy's solid, and it justifies higher rates. Now, you always worry about what's going to break going forward. The administration coming in, they will have more information on it, but even tariffs take quite a while to kick in. in. They don't kick in overnight. And I think people forget about that, and we don't know what not only will the tariffs completely look like. We have ideas, and we can model out scenarios.
Oh man, we're going to be changing. It's no longer the gravy train for the assets that we're holding. It's going to be annoying.
That's very important, because when you're thinking about it that way, that is inflationary, and we're in a much more fragile supply chain environment, which we've already seen. Vehicle prices have already gone up again, just in response to the damages and the buying ahead of additional price hikes due to 2 monster hurricanes. So we're in a situation where we have much more fragile supply chains with the embers of inflation still smoldering. That's just not a situation you want to add fuel to the fire on.
The market's being a little bit dramatic, but again, the market has been known to throw really big fits when it comes to stuff like this. That's always the
but a soft landing, really, they will not declare victory, and this will not be Chairman Powell that we saw a year ago, who was pretty jubilant a year ago. When we were sitting in this exact spot, I think you're going to see a Chairman Powell that is cautious,
so go back to safe names again. Yeah, the Warren Buffett list.
Talking about the strength of the economy.
You go back to the Warren Buffett list. That's where I'm going to be hiding for a little bit here.
That's what looks like it is, not front-running policy.
Michael, I got a 10-year yield moving, the real yield. The real yield was a 2.05, 2.02. All of a sudden, I'm popping 4 basis points, rounded up out to 2.13%. What does that signal
Bitcoin may break down below support again here.
What does it signal
continue
to
going down.
business?
How long before we actually have Jerome Powell come out? About 11 minutes?
6 months.
It tells me that investors might have been tilted the wrong way coming into the FOMC decision.
No, everybody knew it was going to be a
we'll see where it closes. I'm pretty optimistic things will settle down. I think
again,
Diane said it
I'm going to mute him just for a second. I have been trading for a while. I've been doing stuff like this for a while. Oh, there's Loki saying hello. But if I could see they were going to go for hawkish, I could read the papers and stuff like that. It's not too hard to believe that Wall Street knew this was coming, right? I hate when they act like people were surprised. No, people just, they just have to wait for the news to break before they make their trade, if that makes sense. A lot of people have already been placing bets like this for a while. That's why when you look at the daily chart for something like the NASDAQ here, right? People already knew this was coming, and now we're just seeing another bad day of it. The NASDAQ, right? This is a little bit different because of big tech and some of the good plays, some of the good news we heard out there from some of these earnings. But SPY, everybody knew. Tech is just kind of its own thing since the AI and whatnot. But again, it's just, it sucks. It sucks so much. There we go. Let me put the volume back on here.
Drawdown in the Standard & Poor's 500.
Thinking about tech bears, when tech falls, it's going to fall very, very hard, very, very fast, and it's going to be a really nice opportunity to scoop some up. But for me, tech is more of a dollar cost average thing. If I really want to buy heavy into tech, I have to really wait for a crash. I mean, like 40-50% down for NVIDIA before I buy it, like something that drastic,
and then ultimately,
at least.
You think they're done for 2025. Matt, are they getting closer to your world?
Well, yeah, I mean, you have to say that the dots move closer to that world today.
Signaling two fucking cuts for 2025. Two cuts for 2025.
On the dot plot. But what drove that was this big
oh my God, they're going to fuck up the economy so much.
Oh,
this is going to be
their core
bad.
piece inflation forecast to 2.5%
Although
next year.
They're signaling it, if the economy gets worse, they will cut more than twice. But again, it's a lagging effect. We don't feel these things for a while here.
It really takes till 2027 really to get back to their inflation target of 2%.
Higher market caps will feel better. Always. We were just, me and Larry were talking about
risks to the upside of inflation. Everybody kind of
Larry was talking about stuff like Coca-Cola, but I was talking about
much more balanced risks to the labor market. So
how do I say this? Like the Warren Buffett stocks, Goldman Sachs stocks, that type of stuff. Things that have really good earnings, really good fundamentals, and you just can hold them to any environment because even though they may go down temporarily or something like that, they're still going to have, they're still going to survive, not crash and stuff like that.
In other words, is this as Neil Dutta says that they cut by 100 basis points and then Trump walked in the door?
Yeah, it's a
think
fair
lot of
point.
this is just the incoming data that we've seen. You know, they marked up their growth forecast, as everybody else has, by about 50 basis points since the September meeting. They marked up their inflation forecast, just given the incoming data, by 20 basis points since the September meeting. Marked down their labor market forecast by 20 basis since the September meeting. I think the data since the September meeting confirmed a few things. One, growth is robust. Two, the downside risks to the labor market and consumer are less than they were 3 months ago. And three, there are risks that inflation is just stickier than many anticipated. Just to put into some context, core PCE ended last year at 3%. It's likely to end this year at 2.8 or 2.9%. That's very little progress over the course of this year, and they basis points despite that.
Matt, Jason Furman just publishes up at Harvard teaching Act 10. His first sentence, Matt, is simple. I don't know why the Fed cut. Matt Lazzetti, why did the Fed cut?
I think it's a great question, and as was kind of discussed, we thought
they're
there was
living
a
in
lot
a
of good
different
reasons
world
not
than
to
us.
cut. I think when Chair Powell was asked this question, it's going to be a difficult one for him. But the way that I think he'll frame it is, they still believe that they were restrictive, and we still believe that they are as well, and that even with a 25 basis point cut, they maintain that level of restriction, and that they're still kind of being able to balance the risks assessment from a labor market inflation perspective at this point in time. So I think that'll be the argument at this point. That said, I think the signal from them is that they're not just on this regular cadence of rate cuts. They're not just
nobody cares about the FOMC right now. It's still at 18 on trending.
Kind of
nobody cares about it right now.
That it does look like they are going to be pausing for a bit longer here, given their baseline forecast for the data, and that's in line with our own expectations. That the data flow, we think, over the coming months and then coming quarters will just not be consistent with dialing back more restraint.
Tom, I thought that was a great question, and I'd like Bob's answer, because honestly, I think that really is a key question, and it's going to be very difficult for this Fed chair to really answer.
If
you actually are upgrading your expectations,
Twitter's algorithm
PCE,
online is one of the worst I've ever
meeting?
seen, and I will stand by that.
Yeah, and so Matt may eventually be right that this was the last one. As he was talking, I was thinking, boy, this is really reminiscent of 1995 when they had hike rates from 3 to 6%. Everyone thought they'd have to cut rates to 4. They did 75 basis points. That was it. 5 1/4, and then they
Aren't cuts good for Bitcoin's price? Yes, but what ended up happening was, everybody kind of forecast like what's going to happen in the future, how many cuts are going to have in the future. The Fed just said they're looking at 2 rate cuts for all of 2025, just 2. And if they do 2, that's not the best for us here.
Unemployment rate. You've never.
But Johan, yes, they did say cut. They did cut by 25 basis points.
Job gains and look at the 6-month moving average, 108,000. Haven't seen that since 2010.
When we talk about these types of moves of what's probably going to happen with Bitcoin dropping and whatnot, it won't happen immediately. It'll happen over the next few weeks, right?
Does it make you more or less comfortable
do some work here, but then eventually then we fall off.
It makes me more
hopefully the market can accept a pause and not think of it as
this is a pretty good economy.
A rate increase,
we'll see
if
what
you will.
Policies look like.
But yeah, this does have me a lot more concerned. I'm probably going to just do dollar cost averaging for the minute with day trading. I don't really feel the need to swing trade until I see a clear.
We'll find that out by March.
Matt Lazzetti, what's the elasticity here?
Clear consolidation with a breakout.
Is
Right now, I don't like this decision by the Fed at all.
Can this suddenly save Jerome Powell? Can we get a suddenly
they're basically calling it a hawkish rate cut, which
year?
means, hey, we're going to cut rates today, but next year, you only get 2 rate cuts,
that,
which is
we
wild.
And consensus have been expecting.
And again, I just feel that way because I see a lot of friends, like 5 of my friends over the past 3 months have been laid off, and I'm like, damn. Now they got severance packages, that last a few months, anywhere from 6 months to 2 months, but
growth next year.
It's not what you want to see, right?
Where we are. Financial conditions are easy. Credit conditions have eased. Sentiment has improved. So I do think that this economy has substantial momentum behind it, and I think can give you strong growth outcomes. One thing I'm a little bit surprised about is actually their potential growth estimate remained at 1.8%. They've been talking so much about productivity growth, the supply side of the economy. I thought that would begin to manifest in a higher potential grth rate in the forecast.
They always said we were going to have 2 rate cuts this year.
Maybe that's in the coming quarters.
How many rate cuts did we have this year?
At a time when everyone's going to try to get him to comment on Trump policy policies, and everyone's going to try to understand just how high
What
the
was
bar
it? We had
is to cut
50,
again.
then 225s, I think it was.
So
Or was
I
it
think,
50 and
I was going to ask
125?
about kind of the level of restriction if
two or
they
three
had
cuts this
3
year.
cuts
Yeah,
baked in.
probably close to that
But I think
one.
it's more about understanding how they're thinking about a few things in the labor market. Bob mentioned, some weakness in the labor market. I'd be interested in whether or not
3
the
minutes
rising
until
unemployment
Jerome Powell
today
comes
they
up.
view similarly
When he
to the
comes up,
rise
I'll
through
make
the
this
summer.
full screen for
I
you
think there's
guys,
many
and I'll take
reasons for
off
them not to. Payroll gains are
Bloomberg, and I'll
stronger.
just
The quits
pause
rate
it
has
here.
moved higher.
Jerome Powell is going to be
the
the
hiring rate
person
has
to watch for
stabilized a little bit.
sure.
Job openings have picked up. But
How's
are they
everything else
as
looking last
concerned
hour?
about this rising
Patriot
unemployment
is
rate
up.
as
What
they
the
were
heck is
during the
Patriot?
summer? Second question, I think, is on shelter inflation. We did have this
Department
big
of Government
downdraft in the latest
Efficiency.
print that went against Chair Powell, saying
Trust
that
the
it's going to be very
process.
slow
It's not
progress
looking
on
so
this
hot
front.
right now, but
How are they just
last
thinking about
24
it over
hours
the next
have been
several
freaking
months?
gold for this sucker,
I
so
think
it's
it's an
not
important
bad.
question for them as well.
Matt, there's one big problem I've got with this decision, and it's the words the chairman used in the last news conference. We don't guess, we don't assume, we don't speculate. That inflation forecast, Matt, are we sitting here and really saying that much has changed in 2 months that warrants the upgrade to that inflation forecast at the FOMC without guessing, speculating, or assuming on what policy is going to do?
So our own inflation forecast is 2.6%. That builds in about 20 basis points from tariffs. So, they'd be a little bit more hawkish on the inflation front than we would be. Just going back to 2019,
It's
I
politics,
don't think
we know
they're
it is,
really
but
building
damn.
in tariff effects explicitly into the forecast as of yet. I do think that
But
that is
overall,
factoring
guys,
into the risk
we still have that
assessments
momentum.
we
We
see
have to
in the
kind
back
of
the
wait to see what
SEP,
happens now,
where
because
everybody kind of shifted back
as we
towards
back
upside
out
risks
here,
to the inflation front.
right?
But that should also make you worried to a certain extent.
Bitcoin momentum has been going up week after week
without
after
tariffs,
week.
It'd be even higher
Oh,
than
shit,
that
did
with
not
tariffs,
need
which
that.
are
There we
likely
go.
coming.
Actually, let me lock
And
this
therefore,
in.
they'd probably be taking out even a little bit more of those rate cuts that they
There
were
we go, right?
anticipating, which was already leaning in a hawkish direction.
No doubt you'll hear
So
lots
all
of
of a
questions
sudden,
about that in
now
about
we
3
have
minutes'
to,
time when this
maybe
news
a monthly
conference
chart
starts.
be a
Matt, we'll
little
let you
better
run.
for us.
Matt Lazzetti of Deutsche Bank, Neil Dutter of Renmac writes in, talked about him a few times already this afternoon.
Right.
The Fed
Monthly
is
chart is still
prejudging
good,
policy.
stochastic all good,
That's one view.
RSI.
That's Neil's
The
view.
weekly chart
and
right
he's talking
now,
about the fact that there
a little
has
bit
been
more
such
trouble,
a
I
huge
guess you could
shift
say, with the
without some
fib
sort
levels
of
and things of
massive
that nature,
change
but
in the tone of the
momentum
data
is so
that
good.
I think people will disagree with.
What
We have some
happens over
people
the
who
next
say
weeks is
data
now the
has come in a lot
stochastic
hotter.
after this. If we
Nonetheless,
continue to
they have
go
a lot
down,
of things
we'll
to
be a little more
explain
bearish, same
in
with
this press
RSI.
conference.
Bob Michael,
I think
are they
day trading is
speculating?
probably the
Are
best
they
thing for me
assuming?
right
Are they
now.
guessing at the FOMC?
Do you know what? Their inflation forecast just struck me as frustration.
Frustration with what?
With the stickiness of inflation. It should be 1.9 to 2% by now. Look at how the labor market has loosened up. Look at how growth has slowed down. And here we are, still around 2.25 to 2.6%. I don't read anything into it more than that.
So basically, do you think that at this point, this is a Federal Reserve that basically really is just throwing darts at a dartboard?
Yes.
I think they have to be, because they don't. They
Well,
don't.
that's essentially what he's saying, but carry on.
They don't know what. By the way, back in 2009, they would have forecast 2.25 to 2.5, because remember, they had the flexible average inflation targeting. They wanted higher inflation for a period of time, and that's what existed in '95 during the last soft landing. Now, they don't guess, speculate, but they model, and they've modeled.
Yeah, I'll turn it
something.
down to like 90%.
I brought this
for
up
you guys.
to Colin Horst. Let me bring it up
80%,
with you.
there you go.
It's real simple. Are they going to stay
And
on
I'll
an
move the mic
ex-post
closer to my
method
head.
they
That
used
should
for
work out.
400 years, or are they actually getting out front and predicting? I don't buy it. They got to be ex-post. They got to wait for GDP to crack, for unemployment to get to 5%.
Right now, they have the cover of both, don't they?
Yeah, exactly. I mean, they're just an ex-post machine. That's all there is to it.
Bob Michael, this was fun. It's good to see you, sir. Almost there, almost at the holidays. After this is like kind of it for many of you I know going into year end, for us included. Physically, I've said we'll be here, but sort of psychologically, we'll be somewhere else.
Okay, you keep saying
after we
this.
wrap up this news conference.
So you want me to still come in tomorrow? When you're
I'm
going to
be here.
checked
You're
out?
going to be
Yeah,
here.
are you going to be here? Or are you
TK's going to be somewhat
here?
checked out.
You're actually going to get to go off.
No, TK's not here physically either, right?
Yeah,
You're done.
I didn't take a vacation.
Okay, now we're just
day
waiting for CNBC
until the Red
television,
Sox
so
were
we'll wait for it in a
eliminated.
second.
Okay, that's my tradition. So that got me to May 10th.
Nice.
And so
Little head and shoulders.
So, I'm taking a
you
couple
could
days
think
off
about
over
it
the
that
next
way.
week to pick up the pieces.
Well, the chairman's here right now, so we should probably cross over down to Washington, D.C. and catch up with the chairman of the Federal Reserve, Chair Powell.
Okay, CNBC's taking a minute. I'm here.
25 basis points.
There we go. Okay, hold on.
Good afternoon.
An error.
My
happened.
colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the
I know this is a little bit more live, but I think Jerome Powell should be coming out any second. Let me see. CNBC's really laggy. Hold on a second. Well, you know what? Fine. We'll just play this.
For the benefit of the American people. The economy is strong overall and has made significant...
Oh, there it is.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, The committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course.
A dartboard theory,
In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Yeah.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that
5 or 6.
I think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year. That inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people. The way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
Yeah, it kind of did affect it, but
the risk and
it's kind of
uncertainty
okay.
indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. as I mentioned, November is back on track. But once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still, going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding again the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that.
I'm pausing for just a second, but yeah, Bitcoin's not liking it. Russell's still not liking it. SPY's not liking it. NASDAQ, of course, this is still a bit of a lag, but it's not liking it. The Dow Jones isn't liking this at all. Oil doesn't like it. Damn, oil assumes this is bad for the economy. The dollar index loves it. All right. Shit. Yeah. Okay. Let me put the sound back on for you guys.
Can raise prices at least for some time. Does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
The main thing is, and this is also a point in these alternative simulations, is there are just many, many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We
Sorry
don't know
about
what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that. That may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, What would compel the committee to be cutting in that situation?
Let me find these numbers.
Wall Street Journal come with the big questions.
We have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run.
Back to a bearish MACD.
We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
Yes, that's a better way to say it than I ever could.
The rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that. But we look at all the financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we made look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions.
For the most part, he's getting some very easy, soft glove questions
from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm
another year or two.
And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
Fuck those jobs.
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. Job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually
it's
below
because he
the
said
level
1 or
that
2
would hold
years.
the unemployment rate constant, but it's not so far below. So you might if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So, but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. You know, if you had a situation where inflation's moving around by 1/10 every few months, that's, you know, we'd have to weigh that against the fact that inflation has, in recent months, been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, you know, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are, we think, are broadly, roughly in balance. And so that.
See, this is why you got to be careful about what influences you follow. Lark Davis was saying Bitcoin was going to pop later on today.
The word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, you know, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. You know, it's just an occupational hazard is to look, oh, those high months are wrong. What about the low months? You know, we have a very low month potentially in November. You know, it's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil. Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully
with these stupid questions.
Of course, that's part of what we do. But, you know, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. You know, a lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
There we go.
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're
Bitcoin is not happy.
A law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Let him ask a follow-up. Oh my God, Bitcoin,
Happy
yeah.
holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been
There was
solid.
no stabilization during his speech. It just got
PDFP,
worse.
Private domestic final purchases, which we think is the best indicator of private.
Take a quick pause from him. Gold, Dow Jones, NASDAQ, SPY, Russell 2000. Oh, Russell's dramatic. Dollar index, oil, and Bitcoin. Unusually large numbers. Oh, sorry about that.
Why we moved
My
ahead
bad.
today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Why can't I get tons of comments normally?
Thank you, from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So,
ooh, that was nasty.
I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way, and that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Also definitely coming down hard right now.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So, you know, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, you know, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but you know, what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that, and it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that.
The stock market is not bouncing like Bitcoin is bouncing. The stock market is going down.
So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, you know, big real wage increases, so that their wages are going up, their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and
the biggest challenge.
We're in a really good place. Our policy's in a really good place. I expect another good year next year.
He dodged the question.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see, and the committee believes, where is that neutral rate?
So I'll say a couple things. First of all, when we write the thing we write down in the summary of economics,
he's not answering the question.
Longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy, and particularly we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it, and I think we're in a good place, but I think from here it's a new phase, and we're going to be cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models.
Oh, this is such bullshit.
And they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags.
That's a long answer to say I don't know.
So I think it's appropriate for us now to proceed cautiously now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria. Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation; they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be. If you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. That's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy
so
prices?
we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks haven't really. Nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of supply conditions, global supply.
Everything is
conditions.
down.
So
yes.
The U.S. is not feeling
except for the dollar
really
index
the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty, very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down, goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Oh, last question, thank God.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. Appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
Oh.
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that.
I'm getting like alert after alert about all my positions going down.
You have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much, and to you.
All right. Well, I'm going to call it a day here. I will talk with you guys a little bit later. No cigars today, unfortunately. But, yeah, long story short, Jerome Powell just, freaking nuked the entire market. I do think Bitcoin has an opportunity to bounce back up. But what I think matters here is that this is going to really fuck up Bitcoin for the next month, 2 months or so, before things start to fix themselves back up. So what we need to see is unemployment tick up a little bit to freak the Fed out, and then they'll start to cut rates again. But you can see Bitcoin's been consolidating for the last few minutes. I think there's an opportunity for us to have a breakout here and try to pop up a little bit higher. 15-minute chart looks freaking brutal. The daily chart does not look good at all. We may end up tomorrow be breaking down below the 20-day moving average again. Ethereum not looking too hot. Solana not looking too hot. We were all so close to these types of breakouts, and all of a sudden, nothing now. The dollar index is having a beautiful time today after that breakout months ago or weeks ago. Russell 2000 dumping. SPY dumping. NASDAQ dumping. Dow Jones dumping. It's all just dumping right now across the market. Gold dumping. So again, I'm going to try to go live later on tonight. I have to go up to a cigar lounge tonight that one of my friends invited me to. It's like a little bit more of a drive, so it's not, I don't know when I'm going to be back, but later on tonight, I'll just put up a video, maybe in a few hours, just giving my total thoughts about what I just saw, because damn, he was not answering questions very clearly at all. And then on top of that, his facts seem to be a little bit funky. So please be careful. Now, this is the reason I was like, hey, be careful with this, because I know we're looking for a cut, but that hawkish cut can fucking kick our ass, and it kicked Bitcoin's ass. It kicked Bitcoin's ass in a heartbeat. So what do you call? See you guys a little bit later. Go on Twitter or watch some of the YouTubers. They may have some interesting insights as well. But I'm glad, even though everything was aligning for a bullish move, I'm glad I didn't pull the trigger, because I would have lost a shit ton of money. You know, Bitcoin's down like 1.5%. Oh, no, it's going to be 4 or 5%. But I mean, we got a ton of altcoins down 10, 15% right now. And that's just bad. And that's all Jerome Powell's fault. So let's see if we can get rid of them. Remember, Trump's side and Elizabeth Warren, Bernie Sanders' side, they can work on some things together. And one of those things may